Welcome to the Paper Trail, where we follow the journey, my journey, through the world of a CEO of a mortgage note fund. I'm Chris 70, and after years of buying, managing, and selling notes with 70 investments, I'm here to share the real stories behind the deals. What went right, what went wrong, and what I wish I knew earlier. From non-performing loans to seller financing to private lending, this show is about more than strategies, about growing your business, learning to follow the paper trail, and doing the due diligence that separates the pros from the rest. Now, let's hit the trail running. Welcome back, everybody, to another episode of the Paper Trail podcast. Today is actually one of my favorite episodes this time of year. I record two episodes. One is going back and looking at my predictions that I had from 2025 and kind of give myself a thumbs up, thumbs down of how I did. And then the other is we were going to talk about my 2026 predictions. We will do these in two episodes. Got my freshly brewed coffee here this wonderful morning where it's a cool and balmy 20 degrees here in the Washington, D.C. area. But one of the things before we get started, when I look at my predictions and what do I look at, what am I trying to forecast? All real estate. I really want to target on real estate, the things that impact real estate, and really get a sense for where the wind is blowing. And I am by no means a soothsayer, somebody who I'd say is great at predicting things. If I did, then I could just bet on NFL football games all day long and retire in that fashion. But there's a lot to unpack in real estate and understand first, the media is not your friend. The media does not portray, I think, a lot of reality of what is out there. And there's also a lot of data and a lot of things that can impact real estate, and try not to focus on just one aspect. So let's dive into some of the predictions that I made late last year in regards to real estate. And let's see how we made and how those came to fruition. Was I right? Was I wrong? Or was it a mix in between? First, interest rates. Interest rates were a huge topic at this point last year. And I mentioned that I did not expect any meaningful decline in interest rates in 2025. I thought rates would settle somewhere between the mid fives and mid sixes. And the reality is, and I also mentioned that there's no chance they would drop into the fours. I thought they'd come down a little bit more than what they did. But at the end of the day, interest rates were impacted by bond demand, government debt, and the strong stock market is my Boston accent, which a year ago I thought those would keep those propped up. We are, I think, near all-time highs in the stock market, which to me I think is I don't believe the numbers, I guess, a little bit because it's all driven by the big seven, but the bond demand continues to be very weak in people who want to buy government debt, which impacts interest rates. Of course, our whole government debt situation, which continues in my mind to spiral out of control. All of that being said, I had predicted interest rates again between 5.5, 6.5. When I look online today, they're around 6.25. And I'm going to give myself a kudos on that prediction in regards to where I thought interest rates were and where they end up landing. And again, a lot of this was not based off of housing or all these other situations. It was based on those factors of China doesn't really want to buy, or other countries right now weren't buying a lot of U.S. debt. We continue to spend debt, so supply and demand, we keep putting more bonds out there and there's not a lot of buyers. So they're going to buy them at a little bit discount, which increases the rates. And again, that stock market has not really caused the Fed significantly to cut, the overall Fed rate, which again, apples and oranges to interest rates, but does have an impact on the overall environment. Number two, home prices. This is always a contentious one. And I remember last year people saying interest rates drop a half a point, the prices are going to skyrocket. And of course, it's realtors and mortgage loan originators and all these people talking about how pricing is just going to keep going up, keep going up. I was the opposite. I predicted home prices would soften, not crash. I was very clear. I did not expect any type of crash in home prices. I predicted in some areas home prices would be about 15% below peak. I mentioned taxes, insurance, cost of repairs, lack of good contractors, reduced affordability, meaning incomes were not keeping up with the pricing. That has an impact. That impact does not happen overnight. Real estate is like a slow-moving train. It takes a while for things to gain steam or slow down. I also highlighted several markets such as Texas, Florida, Idaho, Kansas City. We're already starting to see price reductions, and I figured they would continue. I thought that because, in my mind, I'm 50 years old, what goes up must come down. Everything typically falls eventually to some sort of median. And I'm seeing some NFL stats this week. Perfect example was last year, the Kansas City Chiefs were 11-0 on one-score games. This year, they're like 1-5. And 11-0 every year is not sustainable. 1-5 is not sustainable, but everything moves towards a norm. You flip a coin 50 times, first 30 times are heads. Reality is probably you're going to have some more tails come into play. Same thing. Now, I mentioned those markets. Ironically, the top markets to fall or have the highest decline: Austin, Tampa, Miami, Orlando, Dallas, Jacksonville, Phoenix, San Antonio, Atlanta, and Denver. So 1, 2, 3, 4, 5, 6, 7. 7 of the 10 are in Texas and Florida. And again, doesn't need a soothsayer to see this, but you look at those areas, significant building going on. Salaries are not as high as they are in like Boston and DC. When I see homes in certain aspects of Florida, in Texas, and neighborhoods selling for the same price as some of the areas around Washington, D.C., which is considered the highest income areas in the country, or Boston, something's got to give. And the reality is either income comes up or pricing goes down. And typically it's pricing goes down. So I'm going to give myself a thumbs up also, by the way, on home pricing. So I'm 2 for 2. Number 3, mortgage defaults and delinquencies. This one, I believe, was a softball because we're at historic lows coming out of COVID for mortgage delinquencies. So I predicted a continued rise, and we'd start to continue to move back towards historic norms. The things I pointed out were serious delinquencies starting to return to pre-COVID levels, 30-day mortgage transitions, meaning loans moving from performing to non-performing, rising above 3%, getting closer to 4%. Younger borrowers buying homes were getting hit the hardest. I had predicted defaults would go up by about 1% and start getting back to that mean reversion. 1% was a big number. It did not go up that significant, but continues to rise. And I'm reading a chart right now. All loans are floating right around 1.7. Conventional has still stayed its course right around about 1%. FHA has gone up over 4.1%. That was increased. VA is up over 2%. And these are only bank loans, so this doesn't include the private loans like Rocket Mortgage and others. But definitely seeing the increase. And interesting, and this will tie into some other topics we talk about, the lower the down payment, the higher risk of default. So people who do seller finance, people who originate loans, the higher the LTV, higher risk of default. This has been known throughout eternity and time and continues to stay the course. Okay? Only at one time in history has conventional been above FHA, and that was in 2010 and 11, where they're about the same. Outside of that, there's always, and I'm just looking at the chart, been pretty significant gaps. They did tighten at some point in time, but they're typically 2 to 3% higher, which is significant. Other things from a year ago that we talked about: credit card balances surpassing $1 trillion, borrower credit scores drifting lower after peak pandemic. Now it's interesting because one of the things we talk about, government intervention, and how government manipulation and intervention can impact these numbers. I'm not sure if people caught the news this year, but the government, the GSEs, government-sponsored entities, technically not owned by the government, but sponsored, are looking at getting rid of the credit score floors for loans. So they can essentially almost give a waiver if you're below 660 or 680. Oh, you still have strong other data, so we can give you that loan. Why are they doing that? Because more people will be eligible for loans. More people eligible probably means increased defaults, but in the same token, typically means there's more people willing to buy, which actually would probably drive up prices slightly. But the way I look at it is, from a non-performing note investor, you're going to see more defaults if there's more people with bad credit getting loans, because those people typically going to have lower down payments. So on that one, I'm going to rate that neutral. Knew it was going to increase. We see a ton of inventory, more than we could ever buy, but I was a little aggressive on the percentage that it would go up. Number 4, economy. I projected ongoing financial pressure on households due to higher taxes, higher property insurance, elevated costs of goods, elevated costs of services, wage growth not keeping up with inflation. I mentioned if unemployment rises, strain would intensify and accelerate delinquencies. Okay. We have, and starting to see, continued increased unemployment. Now, unfortunately, it's my understanding that the government now is not publishing October data for many different key categories. So we don't know, essentially, exactly what the data is. But let's use a little common sense. When you see major companies eliminating 10 or 20,000 jobs, that's a problem. What I find mind-boggling, honestly, is Black Friday. My wife and I made, I guess it was probably me, the uneducated decision of, hey, let's go to the mall because we're looking at getting a new couch. And the store we're looking at had a place in Tyson's Corner Mall. You could not find a place to park. You could barely walk through. It was like being 15 minutes early to the line at Disney World or like outside of a football game. You were elbow to elbow with people throughout the entire mall. And I'm sitting here scratching my head like, everyone's saying they have zero money, they can't afford any bills, they can't buy a house, they can't do this. But the mall is completely jammed. And it contradicts a lot of things that, you see elsewhere. But when I look at overall big picture, and again, in housing, how is this going to impact my business? Taxes continue to increase. Property taxes are skyrocketing in many areas. Property insurance continues to skyrocket. Trying to get anything done, we just got a quote to touch up paint property. It's probably 50% higher than it was 2 years ago. And wage growth, again, is not keeping up with inflation. And throughout this year, I think we've seen all of those things occur. Starting to see the cracks. Data is not now getting published, probably because of these cracks. I don't know. It's none of my, who cares in that sense? It's what do you actually see with your eyes? And on this aspect, I believe I was right on. Overall, from an economic standpoint, again, which way are the headwinds blowing? The wind's blowing towards a stronger economy, which some people may look at certain key points of Bitcoin or the stock market. But when you really unfold the AI potential bubble that's out there and other types of stresses and pressures, what's going to happen over the next year? We'll record that prediction. But over the past year, a year ago, I thought the winds were blowing in a softer direction for the economy and housing. And that one, I'm going to give myself a thumbs up. I believe I was right on cue in regards to where things were headed. And I actually pulled up a chart on unemployment. And last year at this time, unemployment was at about 4%. And now it is up to about 4.4%. So it's increased about 10%. In 2023, it never passed 4. In 2024, since June, it floated between 4 and about 4.2. Then in June, it kind of went down slightly, and then it's been kind of going on an incline, pretty consistent incline since that time through September. Again, we don't have October's data, so can't highlight on that. Other avenues I talked about specific to real estate, asset class risk. During COVID, everyone was chasing shiny objects. The biggest shiny objects that I saw people chasing, short-term rentals. Especially short-term rentals outside of Class A locations. I predicted that there would be trouble for short-term rentals, especially in non-vacation markets where operating expenses and insurance costs will continue to climb. Not only have short-term rentals in non-vacation markets taken a beating, and what you're now seeing people do is go from, oh, I'm making this to a short-term rental. This doesn't work. Now I'm going to do a mid-term rental and then spend a year proving to themselves that philosophy doesn't work. Then to a long-term rental, which the numbers never worked from that standpoint. So the evolution of the short-term rental investor trying to just chase money, it doesn't work. Now, even on locations that are in good locations, we foreclosed on an asset in a golf course community 10 minutes from Disney World, which in Orlando, which is a Class A vacation market for short-term rentals. That area got hit. Everybody started doing short-term rentals there. You're starting to see some decline in number of people going on vacations out of that area. But also, interestingly, like this property, it was set up for a short-term, well, they were going to short-term rental it, but they never furnished it. So then they're like, oh, let me do it as long-term rental. Number in a million years never worked as a long-term rental. They were stuck. Put about $200,000 down on this property to lose it all. So they lost, overall, this borrower probably lost about $300,000 on this property. That's an expensive lesson. We have another one, a beautiful home in mountains of Pennsylvania. Same thing. During COVID, beautiful place that people would want to go. Today, yeah, people will go, but not in full droves. You got back to office people and people going back to from the suburbs or from the rural areas back to where they need to be. For the short-term rental market, I thought this was honestly an easy predictor. Because what influences caused that huge spike? Was it a normal economy or was it something radical? Which was radical. It was COVID. And people could go work from anywhere. So people wanted to have more space or just go live in nature. Now, I would have loved to do that as well. But now that party's over and it's back to norms. And I've shared this story on other podcasts, we had a rental property out in Shenandoah. We bought the property, but it was a one-bedroom condo, 700 square feet, whatever. We bought for like $20,000 at foreclosure in 2013, I think. Put about 25, 30 grand into it, whatever we did. Did it as a long-term rental. It was getting like $700 a month on it. So it was paying for itself, paying mortgage, cash flowing, $50, $100 a month. It wasn't a huge amount, but it was more, hey, we just hold it. It's paying for itself and bank on the appreciation. I think during COVID, we sold it for like $120,000 during COVID. Today, if I looked, I bet you those units are probably $80,000 because there's such a high demand. Now it's back to the normal economy. So short-term rentals, that to me was such a softball one that could easily see coming and came to fruition. And it's unfortunate that a lot of other people didn't see that coming. The other, I'll say, is the survive to 25 motto on multifamily, especially on some of this Class B and C multifamily. I expected softening in rents, pressure on new supply coming to the market because there's a lot of multifamily coming on the market. And the rent growth that you were seeing over the last several years would not continue. That happened. And unfortunately, a lot of these properties continue to struggle because their insurance went up, their taxes went up, their operating expenses went up. Now their rents aren't going up. And now their loans are maturing or resetting. And I've seen some people who have a 4.5% loan that's resetting to 7.5%. They're not going to be able to survive. And they can try and refi into long-term Fannie Freddie debt. The issue is now they don't have the LTV. They're over-leveraged. And what do? There's been so many cans kicked down the road in this situation. It's mind-blowing how many people, the hidden multifamily bomb that is going to go off. And it's a matter of time, unless they can hold on. But many, unless you're a big company, some of these smaller operators between, I'll use the term, $2 and $20 million, it's not going to end well for them. You know, and I predicted that at the beginning of the year, and we're seeing it. We're also seeing it firsthand. So unfortunately, everything that we said was going to happen pretty much in the space continues to occur. Another prediction, seller financing with these high loan to values. I mentioned that these LTVs over 90% were, quote unquote, a ticking time bomb. Now, I compared the correction for the to the contract for D blow up that happened 5-6 years prior. This one, it's still too early to tell. I haven't really seen the data on this because it's really difficult to see the data because this data isn't public. Where are we at with this? It's still too early to tell if I was right. We've seen, again, the increase in the high LTVs. In this instance, still unsure where this is going to play out. I still believe this is still a ticking time bomb in this space. I will say it's not a huge space. I forget how many billions of dollars, but on a $16 trillion industry, I forget the size of seller financing. Fred and Tracy Rui published great information on it. But a lot of these land deals and some of these other deals we'll predict in our few other episodes. But in this one, I predicted it's ticket time. I'm going to say I lost on this one because it didn't come to fruition this year. Doesn't mean it's still not a risk. Just this past year, it didn't occur. Okay. Fix and flip investor loans, residential transition loans. Expected more defaults. I warn that some lenders are not going to survive due to weak underwriting, excessive leverage. I noted longer project times, construction times, higher construction costs, and costlier loan terms. I hit the nail on the head on this one. Defaults have gone up significantly in this space. Weak underwriting. We have bought a good amount of loans in this space this past year because of the price point, because of the amount of inventory, because of the underwriting that is just mind-numbing. The other interesting thing about this space is you also saw a lot of fraud over this past year. I'll share kind of my thoughts on that in regards to the 2008 crisis. Was significant fraud involved with the mortgage loan originators, false appraisals, loan verification, fake applications, just falsifying the information. That's fraud. And then CFPB steps in and basically now requires MLOs to be licensed. And the reason being is MLOs got paid on their volume. Now, fast forward 15 years. What do a lot of these fix and flip companies and brokers do? A lot of them are aggregators that just buy the loans, where they got brokers and originators originating them. What are the originators getting paid off of? Volume. We saw Philadelphia appraisal fraud, Baltimore appraisal fraud, people getting together, and it's a lot of these loans are not based off of borrower financials or credit, but based off property. So we're seeing fraud in that space because people are greedy and not everyone's ethical. I think you're going to continue to see that. We see brokers come to us with loans that have been cherry picked over 3 different times by others, and they manipulate the data based on what they're already being told to try and get the loan. Not ethical, but you have to be able to read through this. And some companies can, some companies can't, and you're not going to catch everything. But when that is happening, that's just going to lead to defaults, but also the SCR loans, which based off of the rental income, rents are down, costs going up. People can't continue to maintain those rates, maintain that income. Also on the fix and flip, projects did take longer. We've got a project that we're renovating a property that taking a hell of a lot longer because contractors in this area, honestly, they just suck. It's just awful. I mean, I've never seen, and I've done construction across the country. This is not even like slightly worse. These contractors are by far the worst. It's like a 5th grade Pee Wee team compared to a professional sports team from what I've dealt with like up in Boston, where I've seen the best quality of work up there. And compared to where this location, it's just mind numbing. But that did happen. Again, so right on in regards to this, and an area where it's continuing to see a lot of defaults continue to hit the space. Next, some macro observations I had affecting 2025. I mentioned incoming administration, introduced uncertainty that made forecasting harder. I think I would agree with this one in regards to, and by the way, I'm an independent. I don't like politicians either way, but I think most would say, some would say the administration is doing exactly what they said they were going to do. Others, I think, are saying there's a lot of uncertainty of what, back and forth on kind of what they're saying. I kind of lean more towards the uncertainty of not sure, wake up in what type of mood, what they're going to do. Tariffs is a perfect example. They're on, they're off, they're on, they're off. From that standpoint, again, not getting into any type of political discussion. I'm talking how it impacts macro observations in real estate. I said the market initially would react favorably, but emphasized that policy clarity would matter. Yes, market, I think, had some favorable. I think right now it's just very neutral in regards to, there's so many factors that impact our economy. We're currently more in a neutral phase of kind of a wait and see approach. And I predicted we're going to start to return to historic norms. We had the distortions from COVID across the debt cycle, delinquencies, credit patterns, back to office, job market. Everything is kind of flowing back to that historic norm. When that happens, real estate, for example, was so easy during COVID. Literally so easy to make money. Having been in it for, again, almost 30 years, it usually is not that easy. We're getting back to the stage where real estate is really hard, really challenging. And it's not just you make your money on the buy, which is an easy out. No, you make your money based on your experience. And I was speaking to somebody the other day, and they brought up the quote of, "Hey, I bet on the jockey, not the horse." And for people this past year, if you bet on the horse and not the jockey, you got crushed. If you bet on the jockey, your chances of getting crushed were significantly less. And I can just share some information about some of the funds that are in the news in regards to whether some of them, for example, a fund out in California that went from real estate into brick and mortar retail and Broadway shows and everything else. Person was a pretty good operator from what I heard when it was just real estate, but then tried to vary off into something else that I don't think they had experience in. And what happens? The money's gone. Another operator who was buying up properties in Philadelphia then turns into golf courses and other things. And, they're now in a lawsuit with the state of Florida getting sued because I don't think they were ever doing anything right, but who knows? We'll let the lawsuits come out on that. So the people who didn't have the experience you don't know what you don't know. And then you're going to be reactive versus proactive to certain economic factors that can cause a lot of damage. I'll leave it at that. Now, that's not to say I am perfect. I am in any way, shape, or form. Things can always go bad. Things can always go bad for any company. But if they do, the person who's flying that plane, steering their ship, whatever you want, do they have the experience to try and get themselves out of it? Or are they just closing their eyes and throwing it at the dartboard and seeing where it lands? That is the difference. Not everything can have that positive outcome, but typically if the operator has the experience, they can lessen that blow. Lastly, I said that one, I think, really loud. I predicted that we would hit 1,000 investors by the end of the year. We came into the year, I believe, it right around 700. And we have our final count, and we still got almost a little less than a month to go. I think we're floating somewhere like around 980, 990. So we are pretty much right on with where we predicted. As a company, it was our best year ever on every aspect of the business. From revenue, from raise, it was a great year. And I just want to give a shout out and thank my team, everyone who, working so hard for us over the past year to get us to where we are. I can't do it alone. I do it because I have great people behind me and working with me. And this year, especially as the year went on, felt like we got into a great rhythm, a great flow of how things were done, and between being very business oriented on systems and people, I thought it was just a great year and hit that prediction. So wrap this episode up. I'm not a guru. I'm not a predictor of things. I bet the odds. And I look at leading indicators to see where the winds are blowing. I do ignore a lot of media. I ignore the bias. I'm an engineer. I look at the data. I look at statistics and what is impacting those statistics. When there's no outlier event like COVID, I recommend people pay attention. Not always have those rose-colored glasses on, and just understand what can impact different aspects of different things. And again, I'll go back to Florida and Texas is just a perfect example where, yes, there's a lot of people moving to those areas, but there's a lot of people not moving to certain areas as well. And when your taxes and insurance skyrocket, and you look at what the median incomes are in that state, and many people living paycheck to paycheck, remember what happens. You can make $1 million a year and live in $1 million house and be perfectly fine. But if your 5 neighbors are all struggling, and they lose their job and have to fire sale their house, and their house is the same as yours in a community, and they fire sale theirs for $750, what's going to happen to your property? You are fine. You can afford the payments. And yeah, you're not moving probably, but that doesn't mean what happens to the other people doesn't have an impact on you. And I think that is an area where a lot of people have spotlight syndrome, where they think everything is about them, not realizing what can happen to those around them. And I was having this conversation with somebody who's got some small multifamily units, and they were talking about like their property and their value and the cap rate and how they're going to refinance. And because, they've got the greatest property, because everyone thinks their property is the greatest. And I was talking to them, going through and I'm like, look, you're predicting like a 7 cap. Everything right now in your area is selling at like 8.5. That's because, and I said, that's because just is why it's selling for that. But that 8.5 cap is going to be used as a comp for yours. And your properties are very similar to those. And understand that a lender is not going to say, oh, just because you believe it's a 7, we're going to write it as 7 where the market's telling us 8.5. So people need to understand that. Well, I hope you enjoyed this episode of the Paper Trail podcast as I went back and reviewed my 2025 predictions. I'm usually a very tough grader, so I'm not going to give myself an overall grade, but I actually thought I did very well this past year, better than I did in 2024 into 2025. But I thought pretty much everything, a lot of these, again, just hit on. So with that being said, strongly recommend you also check out what our 2026 predictions are. So thank you. Take care. Hope you have a safe, happy holiday season. And I'll catch you on the next episode. Thanks for joining me on this episode of The Paper Trail. I hope today's insights help you sharpen your note investing strategies. If you found value in this conversation, subscribe, leave a review, and share it with fellow investors. I'm Chris 70, reminding you to keep doing the work, trust the process, and always follow the paper trail. Until next time.